Welcome to the show. Let's talk to Connor Campbell, financial analyst at Spreadex. Morning to you, Connor.
Good morning.
Let's have an equity review. Let's kick off with Boohoo.com, the stock code BOO, up 92% this year. I assume they're reporting this week. A nice looking chart. What could possibly go wrong?
Yeah, they're reporting on Wednesday. We've sort of got a bit of an AIM stock extravaganza this week. You know, we've got three pretty, heavy hitting AIM stocks. Boohoo, among the best. Bar ASOS, probably the most popular AIM stock out there. As you say, 92% this year, had an incredible year. Take a glance at its figures and it's pretty easy to see why. I think full year back in April, pre-tax profit was up 97%, sales were up 51%, active customers were up to 1.3 million. Very, very strong figures. Sales figures earlier in the year, first quarter sales figures, sales were up 106% to 120.1 million. Incredible, really. That kind of form's expected to continue in the half year. I think half year figures, which they're reporting on Wednesday, expected to be up more than double to 256 million. It's sort of knocking out those humongous figures, and it's really been reflected in the chart. However, it has stalled in the last couple of months since its last sort of major update. There have been issues in the UK, in the wider UK retail sector. Obviously, stocks like Boohoo and ASOS, they're better positioned to weather those things. They're a world away from the sort of high street retail stocks. Exactly. Client-wise, they're buying around the 250 mark. I think it was a fairly easy decision for them. Obviously, if Boohoo misses on those numbers and doesn't, post those sort of mega numbers, there is plenty of room for it to fall. But it has got a very, very good track record. Earlier in the year, I think it did a £50 million share placing. That's to fund a new 600,000 square foot warehouse. They've got big plans for the next couple of years. Our clients are definitely on board at the 250 mark.
Understood. Let's move on to Hotel Chocolat. Stock code HOTC, down 6% this year.
Yeah, it's interesting. Hotel Chocolat, I was quite surprised as I was looking at the chart. This isn't a particularly flattering chart. However, if you zoom back a bit and go to its float last year, I think it floated in May around the 149 mark. 12 months later, and it had climbed to £4. Now, that's not a bad climb by any means. It's fallen since then, I think, again, due to the wider retail sector issues and, people arguably are always going to buy clothes. People aren't always going to buy overpriced chocolates. So I think that's why this stock has been hurt quite a bit in the last few months. However, the figures themselves are very strong. It's half-year figures back in February. Pre-tax profit was up 27%. Sales were up 14%. That was helped by sort of sales of its festive hampers over the Christmas period were up 80%, which isn't bad given that those festive hampers cost between £50 and £500. So that's a really strong growth on what is a very, very expensive product. July update, it's full year sales were up 12%. It said it avoided the summer chocolate sales slump by its new ice cream of the gods product. So it's doing things to mitigate, any pockets that could be a slowdown. It seems to be finding products to try and plug those holes. Also, early in the year, it said it was going to sort of further expand its beauty products range, things like cocoa butters and bath oils and stuff like that. So it's doing enough to diversify away from chocolate, and I think that's why its figures have been doing pretty well. Our clients are buying around that. They've been buying since it hit the 250 mark, buying around that 270 mark. I think a decent set of figures on Wednesday. It's proved in the past there shouldn't be too much of a slowdown this time around. It could see it climb back towards the £3 mark.
Understood. Let's wrap up with Purple Brick. The stock code PURP, up 170% in 2017.
Yeah, another incredible stock. Really, really has exploded this year. Its full year figures back in June, again, it bears out the rise. Pre-tax loss, was down from 11.9% to 6 million, 11.9 million, to 6 million. Sales were up 151%, to 46.7 million. Sort of the crown in its jewel really this year has been that it's now formally launched in the US. I think in mid-September it formally launched in the US, in Los Angeles, with the intentions to further expand into California throughout the rest of the year. Back in February, that is what really sort of got the stock going. But since then, investors have been a bit more ambivalent around the move. When it said at the start of June that it was moving into California, sort of a bit of a dip. As you can see, in the last sort of 6 weeks, it has been falling. I think, obviously, for a company that I think that's only 3 years old, moving into America that's a very, very big step. and that could come with a lot of costs and further eat into their bottom line. However, also, it's been in quite a lot of trouble in the last 18 months with the Advertising Standards Agency. I think it's had like 6 ads banned in the last 18 months, sort of for various claims from how much you can save to sort of the hidden cost of viewing prices and stuff like that. And that sort of reflects our clients have been selling around the £4 mark. I think, again, our clients are a bit ambivalent around that US expansion. Even though it's, they report on Friday, even though it's only 2 weeks since they formally launched in the US, I think any kind of update on sort of early doors, how it's been doing in the US, what they expect the sort of the US division to do for the rest of the year, could help ease some of the worries about that it's bitten off more than it can chew. But like I said, our clients sort of tentatively selling around that £4 mark.
Just around £4. Connor, thank you very much indeed.